In this video, I'm going to give you 5 ways to help you figure out if the market is topping out. Hello everyone, my name is Michael Amat. I'm the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. Now, one of the questions that I'm hearing across the board is, have we topped out? Right now it's the middle of February and the market already had a meteoric run and it's pulled back hard, very hard over the past week and a half. And so a question on everybody's mind, rightfully so, is was that the top? And if it was, what should we do about it? So in this video, I want to share with you the 5 things that I look at to help me figure out if we've topped out. And then if we have topped out, then I have a couple of bonus clips for you to help you figure out what to do if we did top out. Enjoy. I think that the first thing that we all need to understand is what time frame are we looking at? I see a lot of people just focus on the daily charts and short-term moves, and they're kind of ignoring the longer-term trend of the market. So for a shorter-term trader, sure, it's possible that a short-term trend tops out. Meanwhile, a much longer-term trend is still heading in the other direction. So the first thing that we need to figure out is what time frame are we looking at? We also want to know what are the longer-term time frames doing, because the longer the time frame, the more dominant it's naturally going to be. So you can have a short-term pullback within a longer-term uptrend, but when the longer-term uptrend finally tops out and starts to roll over, that's when you'll get everything kind of moving in the same direction. So let's look at a couple of charts and see what I mean. Okay, so what we're looking at here are 3 charts of the S&P 500. We have the S&P 500 on a daily chart, a weekly chart, and a monthly chart. And we're looking at the period way back in 2007, just before things started to implode. And so back here on the daily chart, let's zoom in on this. And this was the move back toward the end of February. We see this big run up between August 2006 all the way through February of 2007. Then we get this nasty pullback, and just in a couple of days it quickly gave up about a little over 6%, and then another week went by and then you dropped to as much as almost 7%. That's a pretty nasty move, and back then people were talking about, was that the top, and what should we do not only on a short-term basis, but what should we do with our longer-term accounts? I mean, look at this. We're breaking below the 50-day moving average. We're big break in character. We'll get into that in another part of this video, but breaking character, wide loose action, breaking below this 100-day moving average as well, and it's just not looking good. So let's take a look at a little bit longer of a time frame and see what that looks like. On the weekly chart, not much better. And you get this nasty break below the 10-week line. You took out, how many months is that? It took out about 3-4 months worth of gains just in a week. And that's a pretty hard pill to swallow. And then you wait the following week and you break below those lows, you rebound, right? So there's a little bit of buyers coming in at that point. Okay, fine. Then you end up breaking that low again. Now psychology is starting to take over some of those intermediate term players of, okay, we're making consistent new lows now, right, for the past couple of weeks, and we are reversing higher, but how much longer are we going to continue to endure that? Are we going to just keep on letting it fall further and further? Take 2 steps back to take 1 step forward? What are we going to do with this? Well, we're getting close to that 40-week line, and maybe that will provide a level of support. In this case, it ended up doing just that. It reversed off that line and found support, closing in the top part of the weekly range. That's a sign of support. But still, this is very nasty action that's difficult to sit with, right? So intermediate term looks pretty bad here too. But then when we zoom out to the monthly chart, and here's the monthly chart, let's find February. Here's February and March, right? And that red line is now the 12-month moving average. It's barely a blip on the radar, right? If we're looking at it like this, still a solid uptrend. Things can change dramatically as we zoom out, not just on the zooming out on the daily chart. So I don't mean going like this, right? So going like this to see where we're at, because that still looks pretty disgusting. I mean switching the time frame, so changing from a daily chart to a weekly chart to a monthly chart. That's where you're going to get this much better perspective. And at least then, in 2007, in February, March, doesn't look that bad to the point where I would be looking to exit my retirement accounts and move those to cash at this point. So we need to know what our timeframes are, and we need to consider the higher timeframes as well, because let's say I am somebody that is a shorter term trader or even intermediate term, and I'm looking at this, or I'm looking at this, and I'm wondering, maybe I should go in and start shorting everything. Well, what do the longer time frames say? Longer time frame says that you're pulling into 12-month support and you're still within a solid uptrend. So if you're trying to short on a short-term time frame, you have to know what the longer-term time frames are doing, because if you bump into them and they are the dominant trend, then you're just going to get smacked. Now, when we're doing this kind of market analysis, it's important to not only just look at one index, so don't just look at the S&P 500, don't just look at the NASDAQ, don't just look at the NYSE, the Russell, the Dow Jones, don't just look at one of them. You need to look at multiple. I like to look at least 3. You could look at more than that, but typically for me, I prefer to look at the S&P 500, the New York Stock Exchange, and the NASDAQ. And the reason why I'm looking at those 3 is because that's where most of the stocks that I'm interested in are trading. You can also look at the Dow, you can also look at the Russell or something else. That's up to you. I would suggest picking at least 3 and then seeing how those 3 are behaving in relation to each other. So after you pick at least 3, then you want to see how they're behaving relative to the other ones. Are they all moving in the same direction? Are they starting to diverge in some kind of way on one time frame or multiple time frames? So when the indexes are moving in harmony, they tend to continue to move in harmony until there is some sort of disruption in one of them. And then when you get this divergence, that's when you begin to see a bit of choppiness in the indexes, and then that choppiness continues pretty much until you get either a move downward or a move back upward. And so what we're looking for is, are the indexes in harmony or are they in disharmony? Let's take a look at some charts. I'll show you what I mean. So here we have 3 charts. We have the NASDAQ, the S&P 500 and the New York Stock Exchange all on monthly charts. And what I want to show you is that when we were looking at the NASDAQ back in 2015, and it was kind of chopping around right below it was making all-time highs, a lot of people were thinking that the market was getting ready to top out back then. And the reason why is because you saw this move here in the S&P 500. It had run from 2009 all the way up to 2015 without taking a breath. A lot of people said that, without taking a breath. I think that this was a significant consolidation for several months. I think that this was another consolidation for several months. I think that those percentages are kind of arbitrary, make just like naming things for the sake of naming things, and I think that that's kind of creating a little bit of a confirmation bias. Shout out to Adam Robinson on Twitter if you're watching this. But yeah, I think that that's kind of creating a little bit of a confirmation bias if you're calling something a bear market. And but anyway, so you're starting to see this market roll over. It's you have this little bit of a rounding top, and then over here on the New York Stock Exchange, you see the same kind of move up, and then it was chopping, and then it started to make a new low here, a new low there, a new low over here, and it's like, okay, well, what's going on? The indexes are starting to move in lockstep, but are they really? We needed to step back and see, well, what's actually happening on one versus on the others. Whereas the S&P 500 and the NYSE had already moved into new highs, the NASDAQ hadn't. And it was getting ready to break into new highs, but it was almost as if everybody kind of thought that it would be very easy for the NASDAQ to take out what had been its all-time high. And that wasn't the case. It took from 2015 all the way really until about 2017 to start making fresh all-time highs. And so that was the reason that, at least to me, that was the reason why we saw this choppiness in the S&P 500, in the NASDAQ, in the NYSE, and why I don't think we necessarily rolled over, and why that was the top. I think that, to me, that was a solid argument of why we were consolidating right at that point. Not that we were getting ready to roll over, that it was just taking a long time for the NASDAQ to finally build the momentum to get to new highs. And then once it finally did, once we finally start to get into 2017, that we know the kind of run that we've had all of last year. Well, one of the better runs that we've had in quite a while. So we need to consider multiple indexes when we are evaluating if we're topping out. Number 3, next thing I like to consider is the character of the market. Have we been controlled and tight for a long time, and are we moving to a period where we are becoming increasingly wide and loose? So let's take a look at some more charts and see what that looks like. Here's a chart of the S&P 500 on a weekly time frame. Back in present day, we could see the recent move that the index has had. Now, about character changes, this is something that's going to work not just on an index, not just on a certain time frame, but it'll work for individual stocks as well. And what I want to show you is how the character changed on the S&P 500. So back in 2016, right here, right after the election and right when we started this march higher, you could see that for the most part, the price action was tight and controlled, and the weekly bars are pretty much the same range for this entire move up. And for the most part, the S&P 500 hugged this red line here, the 10-week line. And so it wasn't really until we started to lift off that line over here, so really starting in January, where we started to see these price bars get much wider and much further and further away from the 10-week line. Even back here, I remember in late October, early November, a lot of people back then were already starting to say that the market's topping out, we're getting extended, look how extended we are off of the 10-week line, and people have hated this market and this rally for a very long time. But back then, it was still, the character didn't break at that point. It was still same kind of weekly bars, same kind of regular price action, and then really to kick off the year, that's when we started to see this what became a parabolic move, what started to get very extended from that 10-week line, and what was a true character change versus something that was really still tight and controlled for a very long time. So we want to check that. We want to check this on multiple time frames as well, and it will become very important to see what things are doing from different perspectives. And so at this point, we could see that the character of the market has indeed clearly changed from what was tight and controlled to starting to get wide and loose, and it gets wide and loose in both directions. It just so happens that on the way down, things tend to get a lot wider and a lot looser in a hurry. You may have heard the expression that the market takes the stairs up and the elevator down, and that's pretty much what we've seen so far here. Number 4. How are leading stocks doing? The reason why I want to know what leading stocks are doing, because naturally leading stocks will lead. The indexes are all made up of different stocks, and it's these leaders within these indexes that are going to ultimately pull the indexes higher or start to drag them lower. So it makes a lot of sense for us to know what are the leading stocks doing, how are they behaving, are they making moves higher, are they topping out themselves, have they triggered sell signals, or are they pulling back into support, and are they setting up in new bases and getting ready to buy? So having a better understanding of what leading stocks are doing will tell us if the market is getting ready to top out or if it is just another pullback within a much bigger consolidation. Let's take a look at some leading stocks and see what's happening now. So what we have here is a subset of the leading stocks that we highlight every week in the Advanced Stock Reports service, and there's about 40 or so big cap leaders. I have a shorter group here just so that way we could flip through some of the charts and save a bit of time. So here's Google. Google pulled back very hard, starting to... it did find support at that 40-week line, rebounded a little bit, pretty nasty action. Facebook similarly pulled back into the 40-week line and is now still chopping around there. Amazon pulled back to that 10-week line and rallied off of that already, still consolidating. Similar to Netflix, hasn't even touched the 10-week line yet. Twitter just continues to make new 52-week highs after 52-week highs, and even with this sell-off, still closing at or near weekly highs. Dr. Pepper, huge gap up and is consolidating that move. Nvidia, barely blinked an eye. SSNC, pulled back to the 10-week line, was quickly bought and is now consolidating. Workday still looks like it's consolidating near new highs. Target pulled back to the 10-week line, and now it looks like it's digesting that pullback. Target itself also had a big move up in early January too, so pulling back to the 10-week line seems like it would be a natural kind of a move. Nothing that would be like a clear-cut sell signal that it's rolling over and is done just yet. Palo Alto is still trying to break above this resistance way back here. This will probably be the next level of resistance at around 165. Seems like it is still on the intermediate term marching its way higher. We'll see if it starts to roll over, consolidate from there. Adobe, biggest winner from last year, still holding on to it, still working its way higher. And yeah, consolidating some major moves, still continuously catching support at that 10-week line for now. MasterCard still working its way higher. What a beast this one has been. You see here a bit of a change in character too, right? Where it had this move, look at the weekly bars. Then over here, the weekly bars are starting to get a bit wider. Even though it was consolidating at this point, the character here has changed from what it was back there. A character change it doesn't always mean that you're rolling over. It's just showing that it's going from something that's tight and controlled to wide and loose. And it could be showing that you're starting to get closer towards the end. I would want to see this start to tighten up. If it does continue to get wide and loose, then you would get more of a correction and might end up being done for a while. Here, this actually, even though you have wide and loose weekly bars for Nike, that kind of seems like it's MO for quite a while. So that's Nike. Dollar General broke out, pulled back, is consolidating around the 10-week line, and I feel like you probably get the idea of what we're seeing at this point. You look at these leading stocks and you get a flavor of what they're doing, how they're leading the market higher or lower, maybe why the market might be pulling back if too many of these leaders started to have that big move and then they need to pull back. And the fact that so many leading stocks are still strong makes me kind of believe that maybe this isn't the top just yet. Tops tend to be more of a process versus a single event, even though you could have a couple of very nasty days, you could have a couple of very nasty weeks. An actual top takes a little bit longer than that to develop. It typically takes several weeks, several months to really have a solid top in where you're going to get this much longer term downtrend. The fifth thing that I like to look at is the number of new highs versus new lows. I like to look at it on both the NASDAQ and on the NYSE. TradingView makes it very, very easy to look at the new highs versus new lows on the NYSE and overlay that on a chart. So we're going to take a look at that on the S&P 500. But I would also encourage you to take a look at the number of new highs versus new lows on the NASDAQ as well, because when they're out of sync, just like how we spoke about earlier, when things are not in harmony, that's when you tend to get a little bit more choppiness, versus when things are in harmony, that's when you tend to get more of a swifter, smoother move. So here's the chart of the S&P 500 again. We're looking at it on a weekly chart, and we're looking at the number of new highs down here versus the number of new lows down here. So the green bars are new highs, the red bars are new lows. And you could see how when things start to rapidly dry up and for the number of new highs and begin to rapidly expand for the number of new lows, that's when you start to get this choppy action. And really right ahead of this big spike down, like you're getting successive down weeks where the number of new highs is greatly outpacing the number of new lows, and the number of new highs is drawing up, and you're getting that dramatically more and more, and it's almost like leading the way, right? Like over here, like back here, right? Like we start to see that spike, then another big spike, and another big spike, and it's preceding what ended up being that big spike down over here. Then interestingly, when we were finally ready to turn the corner in 2009, look at that dramatic dry up in the number of new lows. And you had a dry up in the number of new lows in multiple points, but you get it for a sustained period from March through July, and it just continued of new lows really drying up. You didn't have a dry up in the number of new lows for an extended period like that really since that whole topping out period started. So from 2007, July 2007, all the way through March of 2009, you would get these periodic big spikes every probably like close to once a month to once every 2 months, and for a couple of weeks in between, where you would get these gigantic big spikes down. Then you go for not just 1 or 2 months, but you go for 4 months of not having any of these big spikes down for new lows. That's a signal that, and when you're in the thick of it, when you're in the weeds, that becomes a very subtle signal that people might not be aware of for that turn in the market. So when we do top out eventually, and it will happen, I don't know if this is going to be it, but when it does happen, this is something that you're going to want to be mindful of, because it's probably going to be something that most people aren't going to be talking about. And if you are able to see something like that, then it might help give you a little bit of an edge that, okay, this bear market or this correction or whatever it is starting to come to an end, and maybe it's my opportunity to start to get back in. Fast forward to where we are today. You still have new highs dramatically outpacing the number of new lows. You're starting to get a little bit more of this, these spikes down, and it based on the number of new highs versus new lows, you started to see a little bit more come in over here, and it's not really enough to tell anything from the new highs versus new lows yet. Like, I would want to see more new lows. I'd want to see a continued dry up of new highs to really signal that, okay, what we're seeing right now is the actual top. Thank you all so much for watching. I truly appreciate it. If you have any questions at all, please leave it in the comment section below and I will personally help you. Also, if you like this video, click that thumbs up button. That's really going to help us out a lot. And also make sure that you subscribe to the channel so that way you get every single update. Now, I promised you a couple of bonus clips at the beginning of this, so stay tuned for those. Now, one thing that you may have noticed that I did not talk about at all are distribution days. And one of the things that we're taught if you're following the Can-Slim methodology is distribution days, and that they need to be tracked every single day. And I also track distribution days, and I did a video on how to track them automatically in TradingView. Check that out. But the reason why I didn't talk about distribution days in this particular video is because when we're trying to identify a major top in a market, I found it to not be as useful. I find distribution days to be a lot more useful on the short to intermediate term timeframes to identify when a market might be pulling back. If a market is topping out, I think that distribution is a much more of a secondary indicator, if anything. And so that's why I chose to leave distribution out of this altogether and just focus on the first 5 things that we spoke about. So if the market does top out, what can we do? Well, we could do 2 things really. We could either sidestep the whole correction or bear market and just go straight to cash. By definition, we'll be outperforming the market because we'd have sidestepped all of that, and while the market continues to go down, 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 we are still sitting here in cash. So for those longer term retirement accounts that maybe you don't have the ability to short in, like I have my own 403B accounts, and it's a basket of mutual funds that pretty much mirror the S&P 500, NASDAQ, etc. What I would do for those is move those into a money market account, so that way I still have all the money with Vanguard and with TIAA-CREF, but it's sitting in that money market account, and the market just continues to fall. And then when it finally does start to rebound and we see those signals that we spoke about earlier that it's coming out, then go back in, and instead of being there for the duration, then you exit up here, you get in way back down here, and you're really able to outperform everything. The other thing that we can do if we have a shorter intermediate term account, or even if you're running your own longer term portfolio, you can short the market. And if you have margin on your account, then you could sell short. If you don't have margin on your account, you could still participate in the short side by buying ETFs that are the inverse of some of the major indexes. So for example, for the S&P 500, one that I like to use is SDS. That's the inverse of the S&P 500, and it's 2 times leveraged. Another one is the SQQQ. That's the inverse of the QQQ, which is the NASDAQ 100. There's a whole bunch of ETFs that do this. Check out ETF.com. You can find out information on so many ETFs. It's ridiculous. Very useful site, so check that out. And another way that you could participate in shorting would be to buy options. You could either buy put options, or you could sell calls. So multiple ways for you to participate in the downtrend. Options are a bit more complicated than just trading stocks. So if you are brand new to options, definitely go watch some more videos, get some literature, educate yourself before diving into that world. There are some similarities, and you will be able to apply your knowledge of how to trade stocks to that, but there's additional information that you need to know. So I would not suggest just going in and trying something brand new and plowing into it for the first time before having a good understanding of it. So that's it. That's how I would take advantage of a downtrend, a bear market, or if the market does top out and start to roll over.